When your cash sits stagnant, inflation quietly consumes its purchasing power. To stop this slow drain on wealth, investors traditionally park their money in government-backed bonds or bank fixed deposits, drawn in by the promise of high headline interest rates. Those high rates come with a steep cost. The moment you earn that interest, your income tax bracket takes a significant cut, leaving your actual take-home return much lower than advertised. This dynamic is exactly why investors have historically turned to physical and paper gold to protect their wealth against fiat currency depreciation. This chart shows the difficult spectrum you have to navigate. On one side, traditional debt offers zero risk to your principal, but poor tax efficiency. On the other, gold offers tax advantages, but exposes your capital to high market volatility.
You are forced to choose: accept a guaranteed principal that gets eaten alive by taxes, or pursue tax advantages that leave your initial investment at the mercy of the market. When you prioritize guaranteed principal, bank fixed deposits and RBI floating rate savings bonds, or FRSBs, are the standard pillars in India. The FRSB is a sovereign bond issued by the central bank. Its defining feature is a variable interest rate that automatically adjusts every 6 months to stay aligned with the broader market. Sovereign gold bonds, or SGBs, take a different approach. They are government-backed instruments designed to track the domestic price of gold, while also paying out a small 2.5% fixed interest rate. The government recently halted the issuance of new SGBs. Without fresh supply entering the market, existing bonds have become highly sought after. Recent budget announcements changed the tax rules for these assets, specifically penalizing investors who buy SGBs from the secondary market today. Choosing your fixed income instrument based on outdated rules can easily cost you thousands of rupees in unexpected tax bills or lost principal over the next decade. Let's look at the exact mathematical impact of taxation. For FRSBs and FDs, the baseline rule applies. Every rupee of interest you earn is fully taxable and added to your marginal income slab. This waterfall chart shows how that works for a high bracket earner holding an FRSB. The bond pays a headline rate of 8.05%, but after applying a 30% tax slab, a large chunk is carved out, resulting in a net return of approximately 5.6%. Now, contrast this with the original tax promise for investors who bought SGBs during the initial public offerings. Your initial investment grows with the appreciation of gold, and zero tax is deducted from the final capital gain. To legally claim that tax exemption, there is a catch. The bond must be held continuously from its original issue date until its exact 8-year maturity, and during those 8 years, the 2.5% semi-annual interest paid out by the SGB is fully taxable, just like an FD. The Indian tax code penalizes instruments that generate high annual cash flow while rewarding those who commit to long-term wealth accumulation in gold. Tax efficiency is only useful if your initial capital is secure. FRSBs provide an absolute sovereign guarantee.
The government promises to return 100% of your invested rupees at maturity. The risk of an FRSB lies in the potential loss of purchasing power over 7 years. If the floating interest rate fails to outpace real-world inflation, your money simply buys less. Contrast this fixed rupee guarantee with SGBs. Here, your final maturity payout is strictly dictated by the market price of 999 purity gold. The baseline value of the paper bond that backs your investment relies heavily on domestic physical demand and retail market fluctuations. This line graph tracks recent gold prices and illustrates the risk of government intervention. A steady climb is suddenly interrupted by a vertical drop. Sudden import duty cuts, like those seen in 2024 and 2026, can instantly wipe out value for SGB holders. SGBs are not safe in the traditional sense. When you buy them, you deliberately trade the certainty of your initial principal for a volatile hedge against currency devaluation. All of this math changes if you experience a financial emergency before the 7 or 8 year maturity dates. The FRSB restriction is strict, the 7-year lock-in is rigid, and early withdrawals are strictly prohibited for general investors. Only senior citizens are granted specific exceptions. Because your money is locked in, your yield is trapped too. The rate is pegged at 0.35% above the National Savings Certificate. If the central bank cuts rates, you are trapped receiving lower payouts without the ability to pull your capital out. SGB investors used to rely on a straightforward workaround for this liquidity problem. They could buy or sell their bonds freely on the secondary stock exchange. The 2026 budget closed this loophole. Purchasing SGBs on the secondary market now completely voids the capital gains tax exemption upon maturity. Attempting to game the bond market for early liquidity now triggers severe tax penalties. You are forced to commit completely to the specific timeline of your chosen asset. This scorecard applies these complex trade-offs to real-world financial planning, breaking down 3 distinct investor profiles. First is the retiree. This investor prioritizes predictable cash flow and absolute capital preservation over maximizing wealth. For this profile, FRSBs are the recommendation. They should accept the higher tax burden in exchange for zero anxiety about market crashes or gold volatility. Next is the high earner. This is someone in the 30% tax bracket who already holds original SGB issuances and does not need immediate access to cash. The high earner should hold their existing SGB securely to maturity to claim the tax-free gains, completely ignoring short-term market noise. Finally, we have the short-term saver. This investor is accumulating a down payment or emergency fund and needs their capital within 3 to 5 years. Bank FDs are built for the short-term saver. They must sacrifice tax efficiency to maintain total control and access to their capital. Modern bond investing requires you to choose a single priority up front. You can secure guaranteed income today, tax-free growth a decade from now, or immediate liquidity, because no single asset offers all 3.